when you're fundraising, I typically encourage founders to imagine that you have about 3 months, that fundraising is going to take 3 months, that there are 2 fundraising windows. You could do it after January 2nd to July 4th, or you could do it from September 10th through to Thanksgiving. Those are really your only 2 windows. Now, it's a little bit different today with predominantly Zoom conversations, but the important piece here is that folks tend to disappear in August. If you don't have tons of folks who are willing to sort of engage in the process or available to engage in the process, then it reduces your likelihood of a successful outcome. Fundraising is binary. It either happens or it doesn't. And so the best way to sort of create a structure and process to this is to run one. If your last pitch is your best pitch, what we'll typically do, or what I'll typically do, is for 30 days, I will meet with 20 to 30 founders. These are founders who are 1 stage ahead of us or 2 stages ahead of us who have raised venture capital. I'll sit down with them. I'll have a preliminary deck like I just showed you. It'll be a really bad version of it, but just have anything. And I will pitch Density to them and tell them I'm about to open a fundraising process, but I haven't yet. And I'd really like feedback on what works and what doesn't. And these are trusted folks. Like, they don't have a skin in the game. They just want to be helpful. You do as many of them as you possibly can. Like, stack them. By the end of that process, 2 things will have happened. 3 things will have happened. Your deck will have gotten materially better, like way better. Number 2, you will have found founders who want to invest in you, certainly at the earlier stages. And if they don't invest in you, they will likely introduce you to their GPs, so the people that invested in them, if they're excited. Number 3, you will be substantially tighter on your pitch. And those introductions that founders make to you sort of in the process, you want to schedule for month 2. So anybody who asks if you want to talk about fundraising, if you're actively fundraising right now, or if you've had outreach from investors, don't take the meeting. Strongly encourage you not to take the meeting. You are probably not. I am bad at fundraising right now because I haven't been practicing for the last 30 days. So use that first month to sort of prepare. Second month, you schedule meetings. And the way that you want to think about scheduling meetings is I strongly encourage a screening week where you do 30-minute meetings. And those 30-minute meetings are with investors, anyone who's interested, anyone that you might have gotten intro to previously from the founders that you prepared with. Those screening meetings should be about 30 minutes long. Half of it, you should grill them with questions. What's the size of your fund? Where are you in your fund cycle? Are you raising a new fund soon? How many investments have you made? How many boards do you sit on? Are you a GP? How do you make decisions? Is there an investment committee? Do you have competing investments in a similar space? What's average check size? The reason you want to ask these questions is it's going to give you substantially more information as to what and how they invest. And more importantly, if you ask these questions and you show interest in that process, like, do their LPs have material input in what they invest in? Do they have a particular thesis or mandate? If you ask those types of questions, or even half of the ones I just mentioned, it will demonstrate a fluency in raising venture capital or in what they deal with on their side that demonstrates sort of the seriousness that you're taking this. You're not just talking about you, you're asking about them. You're looking for a really great partner. I am not hard-lined about only talking to GPs or managing directors or not talking to associates. I would say associates can become your best friends, like truly the people that help make deals happen. However, GPs, general partners, and managing directors are the folks that can push a deal through. You need and want a GP sponsor. And so I strongly encourage, in the event that you can, to ask that a specific general partner join your screening meeting. And as many associates and principals as want to join. First 15 minutes, and I mean hard 15 minutes, are asking them questions and taking notes. The next 15 minutes, and only 15 minutes, you open it up for questions. You say, what would you like to know about Density? I'm happy to answer anything that you want to know. And the really great investors will say, actually, I'm really curious about X. I did some research and I'm really sort of hung up on, or I want to know about. The average investors will say, tell me where you were founded. Tell me about the beginnings. The difference between those two things tends to be preparation. And the ones that are really prepared, those are the ones that are more likely to lean in later on. The ones that are just like, hey, just tell me about how you were founded. Take meetings like that all the time. And so your job is to sort of only spend 15 minutes answering questions. And the reason you only want to spend 15 minutes answering questions, and they can ask anything, like truly give them the opportunity to ask anything. Do not share your deck with them. Just talk or answer questions about Density or whatever the company is. The reason you want to do that is because you can't, I don't know if you have to bleep this out, you probably can't fuck up 15 minutes. But you are much more likely to fuck up 30 minutes or an hour. if they are your first conversations with investors. 15 minutes is very hard if you are, really in the game and building a great business. The other thing that's useful is that it allows you to keep the time short so that you can focus on understanding them and whether or not you want to put them as a part of your process. Next week, the following week, I promise I'll wrap this process relatively soon, but these are some of the mistakes I've made in the past. Your next week or your next 2 weeks, you're now in month 2. You've done your screening meetings. Do as many of them as you want back to back, but keep them to 30 minutes and take notes on everybody. Your second week or your third week in that second month, you're going to have your first actual investor meetings, which you have scheduled the month prior. And the reason you want to do that is investors are not busy a month from now. They're busy next week and they're busy in 2 weeks and they're busy in 3 weeks, but they're not busy in 4 and 6 weeks. And that's because they're usually reserving time to sit down with founders and take meetings. So schedule it a month out. You will almost always get on their calendar, provided you get a warm introduction, which by the way is really the only way that you want to generate introductions is warm introductions from founders that they've invested in. Those are the best possible intros. The next best possible intro is an introduction from your investor, your previous investors. And the reason, and I'm going to get back to the weeks in a second, but the reason that's important is because previous investors have something called an IRR or internal rate of return. That's how they mark up their investments. So let's say I raise a $100 million fund, and that $100 million fund, I invest in a whole bunch of companies and it's sort of all gone. Maybe I reserve some of it for follow-on investing, but let's say I've allocated the vast majority of $100 million and I need to raise my next fund. Well, that $100 million I raised just 2 years ago. The goal is to return the fund. It is unlikely that I've seen material returns in that 2 years. So you use what's called an IRR, which is a markup for any of the investments that I made in that period on their post-money valuation for the next investor. Equity rounds, not convertible notes. And there's an important technical distinction there. By understanding what they're trying to do and what's important to them, you are much more likely to successfully fundraise. So let's get back to the weeks. Your second week, you have scheduled meetings with all of these other folks. You really don't want to do more than 2 a day. You get a morning slot and you get an afternoon slot. The reason for that is, and these are hour-long meetings, and you have asked or encouraged them, or they have asked you for a meeting where you actually are going to go through your pitch. Now remember, you've done 20, 30 pitches by this point, 50 pitches by this point. You are super tight. You love every slide that's in your deck. You put in a lot of effort. You're in your second week. You're doing 1 in the morning and 1 in the afternoon. And the reason you're doing it no more than 2, you can make exceptions to this if you have to, but no more than 2 is because you're going to forget what you told somebody if you do 3. You're going to forget you already told the story. Your job is to tell the same story over and over again because it's a tight story. And then the small deviations that an investor asks questions of. The important part is that you really don't want to feel like you're repeating yourself. So 2 a day is enough. Ideally, you got 10 slots, Monday through Friday. Your first 4 days, 3 to 4 days, should be warm-up. You should be not putting your top most important investor or firm that you want to work with or important GP or whoever it might be in those first 4 days, 3 or 4 days. You want to put folks that are maybe lower down your list, folks you don't know or folks that are really excited about you but you haven't gotten familiar with, or maybe funds that you think that you might work with but you haven't spent a lot of time with, and put your sort of number 1, number 2, number 5 later on. Pick your best investor, the one that is your dream investor, the one that you want because you did all this prep ahead of time and you're listening to YouTube and you were trying to understand who these folks are on Friday afternoon. And your morning is again a warm-up. Friday afternoon should be the best pitch you've ever done because your last pitch is always your best pitch. And what that will do is it'll allow you to give an early look to the one that you really want to work with. But you will be prepared enough to show up polished. What's happened in that first week, and then you move on to your second week and your third week, and those second and third weeks you stack with the folks that you actually truly want to raise from, but you just stack them 2 a day and you do them back to back. You do not run your business and fundraise. You fundraise or run your business. It is a full-time effort. I think when I was fundraising last time, I think I lost something like 17 pounds. And it was because I didn't drink. I went to bed early. I drank a lot of water. I was going to the gym. It was like a monk-like life for a period of time. We were in market for 9 days. Meaning when we opened conversations to signed term sheet. And we were very fortunate to work with Kleiner Perkins, who was at the top of my list, and a remarkable GP named Ilya Fushman, who's partnered with Mamoon, who I think has been on this show. And it was because we put in the work ahead of time, I think. Another really important note is like the reason you're doing all of this is because you need them all to mature at the same time. If you do sequential meetings, they are going to mature in sequence, meaning you're going to have a bad meeting early. You're going to fast forward a month and a half. You're still going to be fundraising. You're going to be meeting with a friend of the person who passed on you a month and a half ago. And they're going to say, hey, I'm looking at this company. You know anything about it? Oh yeah, I've met with them. I met with them like, I don't know, 2 months ago. Did you invest? No, it's not. It's too early for me, or they don't really have the traction that they need. And it wasn't because you weren't a great company. It was because your narrative wasn't tight. I mean, maybe it's because you weren't a great company, in which case I can't help you. But if you've got a great company, there's no reason why you shouldn't be able to raise capital. Certainly not in this environment. It doesn't need to be, and it doesn't need to be frothy to raise capital. Some of the best companies in the world raised in economic downturns. So anyway, the point is you need them all to mature at the same time, and you need to be prepared, because if you're not prepared, that first person is literally going to tank that meeting that you have. They're going to walk in a no, and it's because they've got a friend who passed on you previously. Your job when you get a meeting is to get the next meeting, and you just keep getting the next meeting until you have a term sheet. And once you have a term sheet, your job is to get a second term sheet so that you have some pricing leverage over the deal. And then, I would say the reason that you budget 3 months and you work in those seasons is so that you can have time for close. So if it's 30 days for prep, it's 30 days for meetings, it's 30 days for diligence and close, approximately. That is best case scenario, in my opinion. You're going to read all sorts of crazy TechCrunch articles about, like the Brex founders. We put together, we don't put any effort into our deck because that would demonstrate that we're too focused on fundraising and we're not growing fast enough. I think the Brex founders are awesome. I think that's a bullshit argument for not putting in the effort. And I'm not Brex. We've not done what Brex has done in terms of growth. So I defer, I don't have the credibility to say that. But if you put in the work and you do the prep, you don't have to sweat the test. You are substantially more likely to end up with a partner that is excellent in the long term.